Hi there, I'm Irked, and this is my channel Get Irked, where I teach you how to invest for the long term. In this video, I wanted to talk about how you can invest for the long term while still working a full-time job. When you're watching YouTube investors and seeing all these great ideas that they have for day trading, I'm constantly realizing that there's no way that's applicable to me because I have other responsibilities I need to take care of. This is one of the big reasons that I started Get Irked. I wanted to show others that there are ways to invest for the long term that don't require day trading or weird techniques. And along those lines, remember, I'm not a professional, so take that into consideration before using any of the strategies or techniques I talk about in any of my videos. Let's get started. What does it mean to be an investor instead of being a trader? Traders are looking for opportunities that are short-term in nature, whereas an investor should be picking companies based on their long-term potential. A good rule of thumb is this: you want to be able to invest in companies where you can put your money in it and not look at it for 20 years, come back and make a huge profit. Therefore, you're going to want to pick a company that has long-term potential. You're not going to want to pick something that's a trend or a fad. You need to stay away from those. And that brings me to my next rule. Always buy best of breed. A good example of this is the sector of athletic apparel. You've likely heard of both Nike and Under Armour. However, Under Armour is always struggling to keep up with Nike, and Nike is always the best in breed in the space. Sure, once in a while there might be a different company that comes out and really gives Nike a run for the money, but Nike always comes back, and that's the company that you want to think about when you're investing for 20 years. And I've made this mistake myself. About 15 years ago, when I was getting into investing, I decided that I'd go with Under Armour instead of Nike because I wanted to have the upstart play. Under Armour never ended up performing, and I gave up switching to Nike, and I've never looked back. Now, it's okay for a long-term investor to want to be able to speculate, but what you should do is take part of your portfolio and dedicate it to an all-new account. And when I say a small part of your portfolio, I mean maybe 10%. You take that, you put it into a separate account that you dedicate to speculative trading, and that's where you play with it. You never do it in your long-term investing account. Investors and traders should always keep the investing part separate from the trading part. The mindsets are completely different, and therefore you can't have them interlaced. Next up, the best approach is to keep it simple. When you're talking about investing, you should establish a plan in advance and then follow it. It's incredibly easy to get overwhelmed by all the different strategies and techniques that are out there, but you have to remember there are only 3 things that you can do during any stock market day: buy, sell, and hold. And that brings me to one of my personal rules. I never buy on a green day, and I never sell on a red day. In other words, if the market's going up, I have 2 choices. I can hold my positions or I can consider taking profits. And when the market's going down, I have 2 choices. I can hold my positions or I can add to them. Because I'm a long-term investor, I should never be considering buying or chasing up the market when it's going up on a green day, and I should never be considering taking huge losses on a red day because that indicates I'm panic selling. I've made an entire other video about how to sell and when to sell, but basically, if there isn't a news event that's specifically targeting your stock, you shouldn't sell. If there's a market-wide sell-off, that's affecting everything, and that means it's a buying opportunity, not a selling opportunity. Additionally, you shouldn't be too excited to take profits. This is a long-term investment, so even if you're up 10%, let it ride. If you've been watching a lot of trading YouTubers, you'll notice that they always want to be right. Either they're bullish and they think that the stock market's going up, or they're bearish and they think the stock market's going down. As a long-term investor, I don't ever have a bias on which way I think the stock market's going, or at the very least, I don't let it interfere with my plan. The best strategy to deal with up and down moves is to have a plan for both directions. What are you going to do if the stock market goes up tomorrow, and what are you going to do if the stock market goes down tomorrow? A key rule for long-term investing is to stay away from the short time frames. In fact, even the daily time frame might be too short if you're talking about a 20-year or longer time horizon. If you're in your late 40s or younger, chances are you have a minimum of a 20, if not 25, 30, 35, or even 40-year time horizon before you're going to retire. Getting wrapped up in the market's day-to-day gyrations is going to make you panic, and it's going to cause a lot of stress. One of the best techniques for long-term investors is to just not look at the market day to day if you can't handle that kind of movement. For me, the majority of my planning takes place on the weekend. I review all of my investments, I figure out what I'm going to do when it comes to buying and selling, and I put the orders in advance as limit orders with good till canceled orders. That means if I'm in the middle of a meeting or I'm working during the week and there's a big sell-off or a big pop, I don't have to think about it. The orders take care of themselves. Another thing to remember remember is it's always a good idea to do less. Don't feel like you need to be doing orders every day. Don't feel like you need to be doing orders every week. Sometimes weeks go by and nothing happens in any of my portfolios. That's just the way it is when it comes to long-term investing. Another key rule that's important for all investors to follow is that you are not smarter than the market. This one can be very challenging. Every new investor thinks that they can time the market. Every new investor thinks that they're smarter than the market and they can see when a big sell-off's coming. How do I know this? When I first started investing, I thought I was smarter than the market, and then the market handed my butt to me a few times and I realized you can't time the markets. However, one of the best adages I've ever heard of long-term investing is that it's not about timing the market, it's about time in the market. If you feel like the market is frothy, remember that you don't have to go all in, especially now that there are no commissions. Add into that fractional trading and you can go in with a really small amount of money. So if you're feeling like the market is frothy, instead of buying a 25 to 50% position, why not just start with a 10% position and wait to see where the price action goes from there? By putting in a position at 10%, you're going to avoid FOMO, or fear of missing out, and at the same time you're going to protect to the downside in case you're right and it is frothy and there is a big sell-off coming. Another element to being a long-term investor is to ignore the noise, and by noise I mean any of the news that's happening right now. While it might seem like politics or global economics can have a direct impact on your investing, you have to remember that time horizon. Even if the market's selling off dramatically and even if it feels really bad, you have to keep asking yourself, do I think the stock market's going to be way up in 25 or 30 years? And if the answer is yes, then you're comfortable and confident when it comes to buying. If everything's selling off, that means everything's on sale. And as long as you think that's going to be worth more in 20 years, then that means now's a good time to buy, even if it sells off more tomorrow. Accordingly, I'm a big fan of keeping cash on the sidelines. I usually have a large percentage of my portfolio in cash. In fact, right now it's at nearly 40%. Professional financial advisors will tell you that's a mistake, but the key is you have to figure out what works for you, and what works for me might not work for you, and vice versa. One of the greatest strengths about long-term investing is also one of the greatest weaknesses. When you're managing your own investments, it's all up to you what you get to do. You have complete freedom, but with that freedom also comes great responsibility. Sound familiar? For me, one of the most important things is to make sure my emotions don't have any part in any of my investing. This is why I make my plan in advance and I put my orders in advance. The only time I cancel orders is if there's stock-specific news. Otherwise, I let it play out the way that I thought about it when I was objective and not emotional. It's easy to tell yourself that you won't be emotional during a bull market rally or a bear market sell-off, but until it's happening to you firsthand, you're not going to realize exactly how bad it feels. If you rely on your ability to remain emotional during a serious market move, chances are you're going to be wrong and you're going to get caught off guard and you're going to make a mistake. It's much better to put your plan in advance and let it execute. So I'm going to give you a quick example. If you don't really want to research individual companies, you just want to invest for the long term and you want a reliable way of doing it, one of the best ways to do it is with a total market index fund. My preferred provider of ETFs, exchange traded funds, is Vanguard. They've been doing this for years. In fact, they were the first ones to get started doing it. And along those lines, Vanguard has the lowest fees in the industry when it comes to ETF management. You can see from this list that Vanguard offers a lot of different kinds of funds, but the two that I would really recommend looking at are the total stock market, which is VTI, or the S&P 500 ETF, which is VOO. And you can see that they're very similar. Both of them have an expense ratio or a cost of operation of 0.03%. Both offer very similar yields, with VOO offering a 1.24% dividend and VTI offering a 1.18% dividend. And you can see that their performance is very similar, with VOO being up year to date 21.49%, VTI up 20.49%, and over the past 5 years, VOO's been up 17.98% and VTI is up 17.99%, which makes them neck and neck. What's the real difference between the two? VOO tracks the S&P 500, which are the 500 biggest stocks in the United States stock market, and VTI tracks the entire market, which means you're getting exposure to the largest companies, the smallest companies, and the mid caps. So it's basically your own decision. Additionally, you can buy VTI and VOO from almost any brokerage account out there. You don't have to have an account with Vanguard. You can get them with Schwab, you can get them with Robinhood, and you can get them with other discount brokers. Once you've decided which asset you're going to invest in, we're going to use VTI. You can either decide to buy in stages or by percentages on the way down. You can use dollar cost averaging, where you buy some every week or month. Personally, I like to use a blend of fundamentals, which is how the company is doing, as well as the charts themselves, which are called the technicals. Let's take a look at VTI on a chart. This is VTI VTI's weekly chart. So each one of these candles represents 1 week of movement. This is the bottom of the March 2020 sell-off, and this is where VTI is now. If you're using a charting website like TradingView, which has a free service, you can determine levels and draw your own stages just by using Alt-H, which draws a horizontal line. So you can see that right now, VTI has an all-time high of $234.21, and you can also see that the pandemic low is down here at $109.49. If you want some buying stages that were mathematically derived, there's a technique called Fibonacci retracement. Hit Alt-F and draw from the bottom of a move to the top of a move, and you'll get levels that were derived from Fibonacci retracement. Fibonacci being a mathematician who saw certain patterns in nature that repeated themselves, and it turns out those patterns also often repeat in the stock market. In addition to this, you can also zoom in on the charts and see that there are certain levels where there are consistent support. For example, here candles keep tapping on this line, which is about $217.82 or $218. Move down a little bit further and you can see there's more support down here at $209.75. Move a little bit further down and you can see there's support at $194.11, and so on. You can do this using whatever strategy you want. At the end of the day, buying in stages is kind of arbitrary. It's just your decision of when you're going to buy. The key trick is to not buy the entire position all at the same time. From here, watch my playlist on different kinds of investment reviews and what they can do for your portfolio. Hit like and subscribe, and I'll see you in the next video.